Trinidad mutual funds suck. This is why I invest my $500,000 directly in individual stocks on the Trinidad stock market. I do not use mutual funds. Investors generally don't know what stocks their mutual funds contain. The return of the mutual funds are never as high as they promise or as expected. And chances are your mutual fund is costing you far more than you think. Even if your mutual fund is generating high returns, this is just by coincidence and not by design. Let's get into it. When you open up a mutual fund prospectus, it is usually filled with vague technical type language. It might mention things like diversified exposure to equities or strategic asset allocations. Sounds sophisticated, right? But does it actually tell you what you own? Not really. Even if you dig deeper and find a list of stocks, chances are a lot of those names are completely unfamiliar. And as an example, I have two mutual funds prospectus here, one from First Citizens, the Immortal Income and Growth Fund, and one from Trinidad Dollar Income and Growth Fund. So let's see what information they have that can tell a potential investor what actually are the basket of stocks this mutual fund invests in. So I just want to point out that you don't actually see any chapter that's sort of direct the prospective investor on what are the basket of stocks this fund invests in. So you have to dig a bit. And I did dig a bit into this document. I mean, for me, it was really, really hard to go through this. It's not user-friendly. But I actually found what I was looking for. Well, sort of. The information they gave is actually the top 10 largest individual holdings by this fund. So it doesn't give all the holdings. It just gives the top 10. And as you go through the list, you see things like First Citizens Group cash accounts, Allianz Group investor equity account. I mean, I have no idea what this is. They have 3 government of Trinidad and Tobago accounts. They invest in their own stock, which is the First Citizens Bank. They invest in Royal Bank. They invest in NIPDEC. They invest in Scotiabank. And they invest in Ansa Macal. Note, if you go through my stock portfolio, I do have some holdings in First Citizens, but the other stuff, it never registered on my radar. So, investors that are going to invest in this fund, do they really want their money going into these other stocks? I don't know. Let's see with Trin. Let's see if I can find Trin. Actually, how they stated it is actually much worse. So they have a section here called Principal Investment Strategies. And remember, this is the normal layman on the street taking their hard-earned money, giving it to these people to invest with the hope of getting a return in the future. So at least make these documents user-friendly. But I digress. Let's go. The fund's assets shall be spread between domestic and foreign investments of the following description: corporate bonds and debentures, government bonds and other government debt obligations, money market instruments, blah, 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 blah. What is this? I do not know. They even saying, point number 4 here, they even saying that they're investing, this mutual fund is investing in other mutual funds listed on any recognized stock exchange. This is a total cat in bag. No one have any idea. Here's the reality. Many investors don't research the stocks inside their mutual funds. They may recognize a few names, like how I recognize First Citizens Bank, but the rest, you never heard of them. Reutrin isn't even giving you an itemized list. The First Citizens Mutual Fund, they gave you just the top 10 holdings. So, what this boils down to is that individual investors are just investing purely on faith. Faith that their financial advisor at the particular brokerage is recommending the right fund. But how does these brokerage firms recommend a fund? They go through these preliminary analysis where they'll ask you your age, what is your investment target, what is your goals, and based on that, they'll categorize your objective as into low risk funds, medium risk funds, and high risk funds. So your investment objectives will follow into one of these things, which is like a broad brush where, based on your level of risk, they will then have a mutual fund solution for you. This sounds structured, but is it right? I'm not sure. And here's the thing. The questions they are asking, me and you, we can fall in, let's say, a medium risk fund, but your goals and my goals can be totally different. So the solution they are providing for you may not be the right fit for you. And more importantly, it doesn't mean you actually understand what you're investing in.
We lost money. That's a mistake. Buy in your industry, buy what you know, buy local companies.
Yeah,
10 years after Walmart went public, 10 years after
Walmart.
10 years after it went public, it's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. Let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains, and you checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country. They're not even saturated there. Why can't they go to the rest of the country?
That clip was Peter Lynch. Peter Lynch is a legendary American investor who is best known for managing the Fidelity Magellan Fund in the US from 1977 to 1990. Under his leadership, the fund achieved an annualized return of about 29%, making it one of the best performing mutual funds of its time. Lynch was famous for his invest in what you know philosophy, encouraging investors to identify strong businesses based on their everyday experience. And this is my message to you. I'm not telling you that you should not invest in mutual fund, but at least understand the basket of stocks underlying those funds. And in the two examples I gave you, we still have no idea what those mutual funds invest in. The big takeaway here is that most investors have no idea what their mutual fund invests in. They are investing on hope and faith. They are putting their trust in a brokerage and assuming that it aligns with their goals without really knowing what they own. Another item brokerage firms like to market to prospective investors is the performance of their funds. They will either show a chart or a table showing big return values in the 10-year period. If they show a chart, the chart will usually have the curve starting from the lower left-hand corner. And of course, as time goes by, it goes up into the upper right corner. which is indicative of high future performance of a particular fund. But they're also quick to point out that even though they're showing that their fund is projected to perform in the future based on past good performance, they'll also show, like in this disclaimer here, that, let me highlight it, past performance is not necessarily indicative of future results. In layman's terms, if their fund performed well in the past, let's say this particular fund performed well in the last 10 years, that doesn't mean the fund will perform well in the next 10 years. In my view, this data is housed in the brokerage and it's easy for them to communicate this to future investors. Based on the data that you have, give me the performance of your fund from the date of inception to whatever today's date is on an annualized basis. If I go to my stock portfolio, I get this information easily. See, this is my stocks. This is the value of my portfolio. This is my holdings. And if I scroll down here, they simply state that the Millionaire portfolio, which is my portfolio, is a Trinidad and Tobago dollar portfolio that has returned 3.61% annually since inception. It's very simple, very straightforward, very transparent. So when I look at the marketing sites for most mutual funds in Trinidad, I'm just using this one as an example. If you go down, they show a chart showing that if you start with 10,000 in this fund, when it was on inception, from 2005, in 2019, the fund would have raised that 10,000 to a grand total of 16,802, 68% return. I guess this was supposed to impress new investors by saying, yeah, this fund is something that will multiply my returns. But a discerning mind will ask, okay, we are in 2025. Why are you showing me data from so long ago in 2005 to 2019? What happened after 2019? Why don't you show me the performance during COVID, during the period after COVID, until now, as my own stock portfolio has shown me? This suggests to me that the fund didn't really perform very well in the last 5 years. So I don't know. Why not just give me the annualized performance from inception? This is the data you can work with. This is the data you can put on a table, and based on your planned deposits into the fund, you can now project with reasonable accuracy what your portfolio value will be in the next 5, 10, 15 years. But the sad reality is mutual funds typically underperform the market. And this is the secret that they don't want to tell you. Mutual funds are known to underperform the market. And there's an article that I came across. It's based on the US stock market, but US mutual funds are designed in a similar way as our local mutual funds. And based on the studies, it's clear. What they're saying is that 90% of the active public equity fund, which are basically mutual funds, their managers underperform their index. So each fund will have a baseline index, which has similar type of stocks that the fund is investing in. And if they can't beat that index, then you're underperforming the market. And that's generally the case for US mutual funds, and is generally the case for Trinidad mutual funds as well. So let me see what I can find for you guys. Let me have a look at the bonds mutual funds and see how they have been performing. Remember, guys, as a DIY investor, do-it-yourself investor, my fund portfolio has returned 3.61% annually since inception. So when I started this fund, it was in 2019. So since 2019, every year for 2019 to now, my portfolio has been returning 3.61%. So let's see how these mutual funds have been performing. And honestly, this was the hardest bit of information to get. So I'm on the bonds website right now, bonds investment, and they have provided year-to-date returns. They haven't provided from inception to now, but this was the only information I had. So for the SAV Invest Individual Retirement Fund, year-to-date, it has returned 0.77%. So even if you compare this, which should actually be greater than what I have in my portfolio, since my portfolio was surviving COVID, which was a major downturn in the market. So year to date, their fund for the retirement fund is returning 0.77%. They have another fund here that's returning year to date 1.41%. And other one. There's even one, which is a SAV Invest Asia fund, which seems to be a US dollar fund. It is returning year to date minus 2.04%. So that's the sort of returns these mutual funds are giving back to their investors. I made a list of the top five mutual funds in Trinidad. And I managed to, in some cases, in the case of Scotia, they gave me the fund return since inception, which was 2.88%. In the case of Immortal Fund, I had to actually use their 2 annual financial report statements. I put it in the ChatGPT and let ChatGPT calculate what's the return for that 1 year between 2023 and 2024. And it gave me 4.01%. It's not exactly like the annualized returns, but it's the best I could do. Of course, we just saw the year to date for the bonds investment, which was 0.77, and Reutrin provided 6.76%. So, if you guys recall in my earlier post, I had a hypothetical individual earning $9,000 a month. And if he followed my money management plan, which is you spend a maximum of 75%, you save a minimum of 10%, and you invest a minimum of 15% of your monthly income. If I went to the compound interest calculator, so let me bring that up now, which is a very useful tool. So this is the compound interest calculator. So if I put 15% of that 9,000 a month, that will be 1,350. So your initial investment from month 1, you invest 1,350 as the individual who's earning 9,000 a month. Of course, every month after that, he keeps investing 1,350. The length of time is in 10 years. And the estimated interest rate, which should be the fund interest rate. So let's take the 6.76 Reutrin account return. Variance, we will just put 0 for now. So let's see. So after 30 years, let's see what that individual will amass. So what they're saying here is that that individual will amass after 30 years 1,475,358.22. And that should be where I got my values. Yep, right here. So I use this interest rate. And for the other funds, I also calculated what the portfolio value would be after 30 years of investing for that individual who is making $9,000 a month. I kept unit trust here because I spent a lot of hours sifting through the unit trust documents and nowhere where they have the data for the fund returns. That just tells me that that's not a good sign, that their fund most likely have been underperforming. So let's go. So, yeah, there you have it. And as I said, as a DIY investor, if I'm beating the performance of established fund managers, these guys have MBAs, have years and a wealth of knowledge in investing, and yet they can't provide customers with a fund that can beat a normal DIY investor, that raises questions in my mind. Tell me what you think. Put the comments in below. How has your mutual funds been performing? So far, I have highlighted how mutual funds tend to have this secretive basket of stocks that they invest in, which they don't really communicate in a transparent way to their investors what the fund is investing in. And I've showed you that generally the performance of the fund, what they market, isn't actually the performance that it delivers to the investor. In general, they underperform the market. But you might look at this table and say, well, I have a Reutrin mutual fund and it's earning me 6.76%, which is actually a good return. And then you will say at the end of the 30 years, I will have $1,475,358, which is not so bad. But did you know that this 1.4 million, you actually don't receive this amount? A portion of this amount goes to the brokerage firm, and the rest goes to you. But you might think, okay, yeah, maybe a small portion of this amount goes to the brokerage firm. Let's get into it. If we look at the prospectus for the Savvy Invest Individual Retirement Plan by Boss Investments, let's have a look and see what are the management fees associated with investing with this mutual fund. Typically, this section will reside in all prospectus, and it will be management fees. And then they will go on to talk about trusteeship services, fund manager services, and other items associated with the fees for managing the mutual fund. But you need to focus in on the numbers. And let me see if I can zoom in a bit. If you see what they state here, they're saying that the trustee will be paid in a quarterly fee on the basis of the net asset value. This is important. So the amount your portfolio is the benchmark for how much fees they take to manage the fund. The fees are not based on the returns on the portfolio. It's based on the size of the portfolio. So whether the portfolio is returning high or low, the management fees are guaranteed to be taken away from the investors. So if we add this 0.25%, the 1.75%, and a sponsor fee, which is 1%, you'll get a grand total of 3%. They call this the management fee, or some other funds call it the expense ratio. And basically, what that 3% is that for every 10,000 in portfolio value, you get charged every year of $300. That's 3% of the portfolio value. Now, that may sound like a small amount, but as you'll see a bit later, over the course of 30 years, that translates into a large value due to compounding. Similarly, for the Reutrin TT Dollar Income and Growth Fund, we need to look at their prospectus to see if we can extract what are these management fees. So let's go down the table of contents, and you would see embedded in the table of contents the section management fee and expenses. So let's go to page 8. Yes, and when we go to page 8, we can see very clearly in the section under management fees, what they're saying is that the management fees comprising of those of the trustee and the investment manager will not exceed 2% per annum of the average total assets under the fund. So I showed you 2 examples where the management fees is expressed slightly different. In the case of the bourse investment, they itemize what fee is going to the trustee, what fee is going to the investment manager, what fee is going to the sponsor, and you have to add it up to find out what is your total amount. But in this case, in Reutrin, they gave you the final figure, which is 2%. For the 5 funds, I tallied the returns for each fund, well, except for the unit trust, because I couldn't get that information. However, I tallied, based on the information in their prospectus, the amount of the fees expressed as a percentage of each of these funds. So, for example, we looked at the bourse individual retirement plan, and their fee was 3% when we added it up together. And for the Reutrin account, which we just checked, it was 2%. So the question now remains, if I'm paying 2% per year for 30 years, how much does that actually equal to in terms of dollars and cents? There's an easy way to find out. Let's look at it. Going back to our example for the Reutrin mutual fund, where we had our individual who's making $9,000 a month, following my financial management plan. So that individual is investing 15% minimum of their monthly salary, which will be $1,350. So their initial investment will be $1,350. Their monthly contribution will be $1,350. We are looking at a length of time as in 30 years. The estimated interest rate, which is the returns of the fund, and we saw from the Reutrin prospectus, it was 6.76%, which some of you probably feel that's a good return. But as I said, you don't receive that full amount. So let's see. So we'll use this table to now include the fee amount that we pay. In the case of Reutrin, it was 2%. So if we minus 2% from 6.7%, we will get a difference of 4.76, so that we're putting 4.6 here. So the chart will give you a variation of 4.76 away from this value here. So let's see. When we click on calculate, what we see are 3 graphs. The middle graph, which is the future value of the deposits after 30 years, growing at 6.76%. And we get a final value, portfolio value of 1,476,358. However, if we look at this, which is the line underneath, you'll see that that's the 2%. So what this line is showing is that if we subtract 2% in management fees every year, after 30 years, the grand total that the individual would be paying after 30 years is $659,648.22 in fees. So out of the grand total of the 1.4 million, you'll be paying 659,000 in management fees. And I have broken this down on the table. For now, we can ignore this because this doesn't have any value for our conversation. This top chart, we only focus on these two charts here. The top one is what the portfolio value would be after 30 years, growing at a rate of 6.76%. And the lower chart is what the 2% management fee compounds to after 30 years. So let's look at the table and we can compare. So if you look at the table for the Roy Trin mutual fund account, which grows at a rate of 6.76%, at the end of the 30 years, out of that 1.4 million, you would have to pay the brokerage 649,000, which is almost half of the portfolio amount. So half of the portfolio amount is going into fees. So what the investor will actually get is not the 1.4 million. What they will get is 825,710. What do you guys think about that? Because the brokerage, they aren't risking their money. All the risk is on the investor. It's their money that's compounding to this amount. And out of this final 1.4 million, 649,000 is going in fees. And the investor gets left with 825,000. And it's a similar case for all the other mutual funds. In this case, for the Scotia Balanced Growth Portfolio, that's returning an annual amount of 2.88%. After 30 years, it will grow to $759,676. But take a look at this. Out of this amount, 624,565 has to go in fees. So the investor net return, what they're going to get at the end of the 30 years will be 134,510. Does that seem fair to you? More than half the return are being eaten up by fees. And that's the real hidden danger in mutual funds. You don't get billed for this fee. It's taken out of your account automatically. So you may not even realize every quarter this fee is split into 4 for the year and it's extracted from your account. So when you check your account, you don't see this value. You see this value less the fees. So what this person who invested in the Scotia Balanced Growth portfolio would see is that after years, they'll see their portfolio slowly growing to 134,000, and they'll be wondering, but I'm investing so much into this account, how come I'm only getting this at the end? And they will come with an excuse and tell you, well, it's based on market conditions, and the market has been streamed, and so this, and fill your ears with all sorts of technical jargon. But they wouldn't tell you that the reason why your portfolio isn't growing to the amount that you think it will is because they are secretly taking away and draining your portfolio with their fees. And that, to me, is the ultimate reason why I would not invest in mutual funds. In my portfolio, all the dividend income is mine. It's not the government. It's not the brokerage. It's just mine. And that's the way I like it. Tell me what you think. Are you surprised by the amount of fees you pay over the long run? Let me know in the comments. Now that I've shown you my 3 main issues with investing in mutual funds, You are equipped with the knowledge of how to assess whether investing in a mutual fund is in your benefit. But what I didn't tell you is what are your other options for investing in the Trinidad stock market. Click on my video where I will show you what stocks make up my $500,000 portfolio. And if you're just starting in your investment journey, click on the video on the right and I will show you where I get money for investing. Bye for now.